obviously you guys are in the right place, personal portfolio management. It's the third general body meeting. I missed you guys. 2 weeks without a meeting, I feel like no PPM, it's kind of sad. But anyways, we have a lot to talk about in this meeting. Obviously, the headline of this meeting is the Fed rate cuts. It happened about 2 weeks ago, but since our last meeting was postponed, we're going to discuss it here. One thing I want to start off by is saying we want to deviate a little from these lecture-based meetings and make it a little more interactive. So I want more conversational, more fun. I know you guys are ending class, so you have class early in the day. I don't want you guys to come here thinking that this is another class and you have to listen and take notes. So I want your opinion. What can we do to make this more fun, or what would you guys like to see going forward, if anything?
If you don't have anything to say now, just scan the QR code. You can put questions on the form, and then we can look at them later, and it'll definitely help us improve future meetings, because that way we can have some feedback from you guys.
Yeah, so one main thing with this attendance form, which I think will excite a lot of you finance or business students. I don't know whoever's in Dr. Dolman's stocks class or Mark Painter's, Principles of Finance. We're trying to get those professors to give extra credit for students to come to these meetings. One thing that they're looking for, and the reason they're a little hesitant to give the extra credit, is because they don't know if the students are participating, right? They don't know if the students are just sitting in the back watching YouTube or playing games, or if they're actually getting something out of these meetings. So we'll be looking for some more participation so we can let the professors know, and then it'll keep them happy too. All right. So if you didn't scan the QR code, please scan it. If you came in late, we'll put it at the end. But anyways, market analysis. Obviously, this is the first meeting in 2 weeks, so there's a lot to cover. Let's go right into it. This is something I found super interesting. I love this LinkedIn profile. So Nike CEO was recently replaced. The old CEO, what was his name? Jonathan Donahue, was replaced by a gentleman named Mr. Elliott Hill. Now the fun fact about Mr. Elliott Hill is that he started as an intern at Nike and he worked his way up the corporate ladder, ultimately becoming CEO. I thought this was super interesting because a lot of us are trying to get internships or work entry-level jobs next year. And he just reflects a dream that it's possible to work up the corporate ladder. So I thought it was really interesting to see that. Another thing is investors also thought of this as a good sign. I don't know how many of you guys have been following Nike stock in the last several months, but their stock has been an absolute disaster. I think 2024 has probably been one of their worst years, and it's due to terrible management. That's one of the main factors. Investors saw this new management as a good sign, and their stock was up, I think, around 10% following this news. So investors saw this as a good sign, and it's also super, super interesting.
And so another thing that's happened recently is a Chinese stimulus. So essentially, in China, the economy's been pretty slow for the past few years. And in order to combat that, the government has issued a bundle of funding and interest rate cuts to the Chinese people in order to get more money in the market. I believe they cut from 2.3% to 2%. And basically what they're trying to do with this is hopefully get more people to take out loans from the government and use this money on businesses and have businesses use this money on the people. That way they have more of a cycle flowing.
Yeah, Max speaks from experience. He told me his cousins were calling him, telling him how happy they were about these rate cuts. All right, anyways, let's look at the September recap. At the last meeting, we talked about how September is historically one of the weakest months, and we looked at some trends. I think historically, maybe around 60% of the time, September average is a negative return. Obviously, this month was a very, very good month. One of the main factors was the Fed rate cuts, which we're going to talk about throughout this meeting. So if you guys weren't aware, the Fed cut the interest rates for the first time since 2020. So it's been 4 years. It's a pretty big deal. The Fed doesn't look to cut interest rates for no reason. Just because the economy is doing bad, they're not going to be, okay, let's cut interest rates. Just because your groceries are too expensive, they're not going to say, let's cut the interest rates. It's not a very common occurrence, so it's a big deal. Let's talk about as to why.
So what exactly does it mean when the Fed cuts interest rates? Basically, interest rates are how much is basically how much you have to pay the bank every time you take a loan. So when you take a loan out, by cutting the interest rates, you're able to pay less on each loan and therefore take out more loans and have less money to pay. So this is hoping, basically the Fed's hoping that this will incentivize people to take out more loans. And this will affect things such as mortgages and federal loans as well, such as student and corporate. And I know some of you might have student loans to pay, so this will definitely affect you guys as well.
Yeah, going off of that, one thing I noticed, I have a high yield savings account. I don't know how many of you guys have savings account here, but they have like this rate that they give you on return just for putting your money in the savings account. Mine was originally I think 4.25%. Following this rate cut, it fell to 4.1%. So you guys should check your savings account if you have some. You might be getting less money now. One of the main economic goals that the Fed follows is what's called the dual mandate, which is essentially having maximum employment while also maintaining price stability. So we want to keep the number of employment at the max possible, and then price stability. We don't want the price to fluctuate high, low. We want it to be relatively stable. So the Fed uses the federal funds rate. They cut the federal funds rate to meet the economic goal of dual mandate. Okay, a couple months ago, some of you guys, I don't know who follows the news, might have heard Jerome Powell at the Jackson Hole conference say the time has come to start cutting interest rates. A lot of people thought this was too late, that a recession was looming. We saw the VIX, or the volatility index, skyrocketed, hit 60 plus. If you don't know what that means, the only two other times the VIX has reached 60 plus was COVID, which obviously the market was terrible, and the Great Recession. Not a good sign when it's 60 plus. And then the Somme rule was also triggered. So a lot of people were very fearful. But let's look at some factors as to why Jerome Powell and the Fed waited so long. One of the big factors is CPI. CPI essentially reflects the change in prices of a basket of goods over a period of time. And as this number was approaching the 2% mark, the Fed felt more confident to increase consumer spending by cutting interest rates. So obviously it was at very high point, almost 10%, and it's been slowly cooling for the last several months. So if you guys don't know what the federal funds rate was prior to this rate cut, it was 5.33 or 533 basis points. Obviously we see that besides 2020, there hasn't been a rate cut in the last 10 years. So it's not a common thing, and the rates have been increasing drastically for the past several months. Following this rate cut, the federal funds rate is now 4.83, 483 basis points, and they plan to continue reducing that in the next several months or years.
So what exactly does it mean when the Fed cuts the rate by 25 versus 50 basis points? Well, this was what a lot of people were wondering about the meeting, whether or not they're going to do a 50-point basis cut or a 25. And essentially, a 25 basis point cut is a lot more aggressive than a 25. A 51 is a lot more aggressive than a 25, because essentially when you're cutting rates by 50 basis points, you're kind of in fear of a lot of things. You're kind of worried about the economy, and there's a lot of indicators that will show that the Fed needs to cut by a lot to get more money pumping. If they only cut by 25, it kind of shows that the economy, they kind of want to show the idea that the economy is doing well and that there's not much to fear for investors.
Yeah, heading up to the rate cut, you probably saw a GroupMe message saying 50 basis point cut. All right, what the hell does that mean? A lot of people were fearful of the 50 basis point cut because their minds are thinking, if the rate cuts are reduced so drastically, then people will be able to take more money out for cheaper through loans. They'll have less interest rates, and they'll increase consumer spending. If we increase consumer spending, could that drive inflation up in the future, right? So right now, in the last several months, we've been working so hard to get inflation to cool. With the increased consumer spending, will inflation rise again in the future? That was a fear for so many investors. So what's the future of the rate cuts? Does the Fed just cut interest rates once and then never touch it again? Absolutely not. They plan to cut the interest rates by an additional 50 basis points in 2024, and then 100 basis points in 2025. We're expecting it to be around 2 meetings in 2024, 2 additional meetings in 2024, and then around 4 meetings in 2025, hoping to get around that 3% range in 2026. So we'll definitely keep an eye out for Jerome Powell and all his buddies in the next several months.
So now, how does the rate cut affect the economy? Well, there's 2 parts of it. For the consumer part, it affects the HELOCs, which is essentially the home equity line of credit, and it measures how much money you can take out against your house. And it'll also affect mortgages, which is how you pay for your house, and loans, which is a little more general. So essentially, the rate cut will lower the rates on these things as well, which will allow people to buy a house, take more money against their house, and take out more money in general to spend on other goods and things that they need. And also for the business side, they are able to take out more government loans because of the lower interest rate. That way they have more money to spend on their business, invest in their people, their products, and more importantly, employment, which also connects back to consumers, giving people more jobs and more stability in the economy.
So what's the impact on the market? Let's look at some historical trends. Generally, following a rate cut, we can see positive trends in the stock market. There have been 2 terrible examples in the past few years. 2000, obviously, we saw the dot-com bubble, and then 2007, the housing market crisis. This just goes to show that historical trends don't always reflect what's going to happen in the future. Right? We saw following this rate cut, the market reacted positively. Do we know a recession is going to come? We don't know yet. Jerome Powell says the economy is strong, but I guess we have to see. Previous examples, a recession has followed a rate cut, so it could happen, but I would say historical trends don't always replicate what's going to happen in the future. So if you guys weren't aware of how the market reacted following the rate cut, here's a visual of just the day after the rate cut. We saw the S&P was up about 2%, NASDAQ 2.5%, Dow Jones over 1%. The market reacted very positively to the news. Obviously trading was, I think, negative the day of the rate cut, and then following the rate cut the next day, it was very positive. So investors reacted well to this, and then we saw it's been about 2 weeks, the markets have been going trending upwards, so investors are, for now, satisfied with the 50 basis point cut. Okay, that ends the discussion of rate cut. I know some of y'all were interested about FinViz and how to use it, so we're going to talk a little bit about FinViz. So essentially what FinViz is it's a stock screener to efficiently select stocks using some filters and criteria that you desire. I'm sure when y'all see this website, you're like, holy shit, there are a lot of numbers, there are a lot of pictures, red, green, what the fuck does this mean, right? This website looks super confusing, and what I would say is FinViz is a really simple, easy tool to use. I ignore most of the stuff on the website, and we're going to do a live walkthrough where I'm going to demonstrate it, but it's really easy. Now this FinViz stock screener is tailored to different investment strategies, like fundamental analysis, technical analysis, and we're going to show you a little of how it can be tailored. So one thing to keep in mind is when you use a stock screener, based on the filters and the results it gives you, you don't want to just go and invest into those stocks. You have to remember that using a screener is just the first step of fundamental analysis. So we're going to teach you fundamental analysis throughout the semester. This is just the first step. After you use the screener to select these stocks, it'll give you whatever amount of stocks you want to choose. Then you go deeper into those, look at the business detail, the financials, the strategy, the valuation, and then decide if you want to invest in it or not. So let's do a live demo. If you guys want to scan this, you can access the website yourself. I promise you it's not as scary as it looks. Or you can just search up finviz.com on your laptop if you want that. Okay. So here we have the website. It's a free website, so there are going to be ads, so watch out for that. Does it take you guys to the home page or the screener page? Screener? Okay, that's good. So the screener page is the only page that I use. You'll see there are tons of different tabs. Honestly, I've never even clicked on other tabs. I don't know what they are. I would completely ignore them. But yeah, even this page, it looks a little intimidating. You can see there's the descriptive column, fundamental, technical, news, ETF, and all. I only look at the descriptive. Now, some of you are probably thinking, Sanj, why don't you look at fundamental? Aren't we performing fundamental analysis? Let me tell you a little why I don't look at fundamental. So if we look at the fundamental, you've probably seen all these ratios if you're in finance, like the PE, PEG, price cash, earnings per share, whatever. A PE of 50 or 30 or 40, 10, whatever, doesn't necessarily mean anything on its own. You have to compare that ratio with other stocks in the same sector. Finviz can't do that. It just filters, okay, these are companies with a PE under 30 or whatever you want to put. So unless you compare that ratio with other stocks in the same sector, it doesn't really mean anything. So for that reason, I don't really look at fundamental. I don't look at technical at all. I don't even know how to do technical analysis. If any of you guys are interested in short-term trading and like looking at what, like the 200-day SMA or RSI, MACD, whatever, that stuff, you can look at that. I don't know what any of that stuff means, so I'm not going to teach it. But I like to look at the descriptive. You can see that it's relatively simple. You can see the market cap, the exchange, index, sector, dividend, analyst recommendations. The main ones that I look at, number one, market cap. So if you guys see this on your own, it's basically like the total valuation of a company. You take the number of shares outstanding multiplied by the stock price. So it's kind of like the total value of the company. I like to invest in large, reputable companies. So companies that you've probably heard of, have a reputation, they have demonstrated good financials, they've demonstrated growth. So these are generally billion-dollar companies. So I like to select the filter large over 10 billion. Some people like very reputable companies. You can do mega. Those are definitely companies you've heard of. But I like large over 10 billion. So that's the first filter I use. Next, the index. Really, this isn't that important. You can do any. I never look at the Dow Jones, if I'm being honest. But S&P and NASDAQ are the two main ones I look at. And then dividend yield. Sometimes I like to get some extra income, so if I'm looking for that, I'll enter a positive dividend. If I'm not looking for that, I'll just do any. There are a lot of big companies that don't offer a dividend, like Google, for example, they don't offer a dividend. So if you enter that as a filter, Google will not show up. There are several other companies like that. And then sector. Which sector are you looking to invest in? One of the sectors I'm most bullish about, and almost every investor is the technology sector. I think technology is going to continue growing, so I like to invest in companies in that sector. Over the last several years, they've averaged the best returns, so I'm very bullish on that sector. And then the last filter I look at is the analyst recommendations. So there are professional analysts that do all this work for you. They will look at a company's financials, profitability, valuation, everything there is about the company, and they'll give a recommendation of strong buy, hold, strong sell. They'll basically sum up that and give reasoning. If you use a reputable brokerage account, I know Schwab is the one I use. They have like their own analyst recommendations, and then they give a reasoning as to why they give those recommendations. I'm sure Fidelity does the same. A bunch of brokerage accounts do that, so you can look at it there. But I like to do buy or better. Not always, but analysts usually have pretty good insight because they're way smarter than us. They do this for a living. So once you enter these filters, it'll select a bunch of stocks based on that criteria. Ignore the ads. So there's about 70 stocks total. A lot of them I've heard of, a lot of them I haven't heard of. So that's a good thing about Finviz. Like for example, Apple. I could go and research Apple on my own. I know everything about Apple. But there's some I've never heard of. Like, I have no idea what that is or that. I don't know what those companies are, but they're still pretty reputable. They have a market cap of over 10 billion. So then if I wanted to learn more about that company, I could go research that and potentially invest if it fits my criteria. But that's what Finviz is used for. You just enter some filters that you're looking for, and it creates like a large basket of stocks that you can potentially research more in depth in the future. It's a very simple tool to use. You just look at the screener, enter some filters that you're looking for. Like if you want a company that's in a certain country, you can enter that. If you want a company that has a share price under like $100, you can enter that. I don't recommend it, but you could. But it's a really, really easy tool to use. Any questions on that? Okay. One other thing I would suggest when researching companies, just the first step, is look for or invest in companies that you know, or companies that you can't live without. If you like a company, if you like a company's goods or products or services, other people probably like it too, right? Declan, you like that shirt? I'm sure there are tons of other people in this room that like that shirt too. So invest in companies that you're familiar with. I don't know if you guys know about the Magnificent Seven, but they're like 7 of the most popular and largest companies. If you get an internship here, I'll have a lot of respect for you. But anyways, a lot of these companies are companies that you've heard of, companies that some of you can't live without. Like, I know a lot of us realistically can't live without Apple. That sounds very spoiled and rich to say, but we all rely heavily on the iPhone. I do. Amazon, I literally shop on Amazon for everything. Google, we're using it right now. Tesla, Nvidia, Microsoft, Meta. All of these are big names that we use frequently. That means other people probably are too. So invest in companies you're familiar with. Just because a company has good financials or good valuation or is growing, but you don't know anything about the company, I wouldn't recommend investing in it. Learn what the company does, learn what their product is, learn everything there is about the company, and then you can look at their financials, their profitability, whatever you want to look at. Okay, that wraps up that. This is something I'm very passionate about. This is not my thing, but something we've talked a lot about in the past PPM meetings, even you'll see on our website, is financial literacy seminars. So I'm very passionate about financial literacy. I think everyone should have access to financial literacy. I think SLU should invest in financial literacy, and even high schools. But this junior achievement volunteering is something I went to last week, and I thought it was really interesting. So there's a program or industry, I don't know what to call it, called Junior Achievement, where they basically go all across the country and you give financial literacy seminars to elementary schools, middle schools, high schools. I thought it was super cool. Reese is also doing it. She thinks it's super cool. It looks like a lot of fun. But it's basically once a week for 5 weeks. The schedule is completely open. So if you can't go volunteering on Friday, or you can go Monday. You could probably go anytime before 2 p.m. The elementary schools are like within 2 miles, so it's not too far. You can take a bus. And they provide all the resources and curriculum. I thought that was super cool. When I went there, they gave me like this big ass box of board games and toys and some other like notebooks and stuff, some fun little activities for the kids. So I think it'll be a good time, and I can't speak about it too much because I've never done it. I just signed up for it this Friday with Luca, but I encourage all of y'all to volunteer. I think it's a good initiative, and it looks like a lot of fun too. So this is the lovely lady you can contact. I don't think she's here tonight, but here's her email if you want to reach out to her. I think it's a really cool initiative. Okay, one of the main things why I wanted a lot of y'all to come here tonight is because we're doing an investment challenge. So it's called the CQA Investment Challenge. What is that, Chicago Quantitative Analysis?
Yeah.
Something like that. which is a 6-month competition. And I know 6 months sounds like a lot time commitment, but you're managing a portfolio with 5 other people. The only real time commitment you have is reading the news, researching some stocks here and there. It's really not a big time commitment. If it was 6 months and a huge time commitment, I would not do it either. I don't think it's a big time commitment at all. But anyways, what it is you're managing a portfolio. This investment competition is very heavily reliant and enforcing compliance. So it doesn't necessarily just care about your returns on your portfolio, but are you following the guidelines that they lay out for you? So they lay out like a bunch of guidelines. They send like this 4-page document. Like you can't hold, you have to hold a minimum of like 40 stocks. Cash can't be like more than 5%. No ETFs, it's just stocks, no crypto. I don't know about options, I don't think there's options. But it's very heavily weighted on compliance. So to qualify for the first round, or pass the first round, it's the top 20 teams. So it's based 100% on compliance. So your portfolio could get negative 10% returns, you could be the worst investor ever, and you could still make it past the first round, if you follow the rules, okay? To make it past the second round, it's the top 10 teams. It's 50% compliance, 50% returns. So now, ideally, you probably don't want to have negative 10% returns. You probably want some better returns while also maintaining compliance. And then the third and final round will be 30% compliance, 50% returns, and then 20% as a video presentation. So I thought this was very interesting. Normally, I absolutely hate stock simulation accounts because it's player on money, you play very risky, it doesn't necessarily reflect good investing habits. This simulation account is more heavily weighted on compliance, and they preach good guidelines that you should follow, so I like it a lot more. And the best part is, $6,000 prize money, $3,000 to the winner, $2,000 to second, $1,000 to third. If we're entering to win. So with that being said, if you go to the next slide, Max. We will be creating 2 teams up to 10 members total. Max and I will be on the team, so we're looking for 8 other members to join the team. To do this, we will be hosting stock pitch interviews. So we're asking students to take 5 minutes maximum, keyword maximum, to just pick any stock they want. We're keeping the instructions very, very vague, and just give a pitch to us on whether you should buy the stock, what the stock is, like everything about the stock, whatever you think is best. Make a presentation, make it look pretty. I want to see some effort being put into this. That's the main thing. If you don't know anything about investing or what to look for, literally search a YouTube video, why I should buy Apple stock or something. You can say that word for word if you want, as long as you can explain it in your own words. Like, as long as it sounds not robotic or ChatGPT, like you actually understand what you're saying, right? So the instructions are pretty vague, and I'm doing that for a purpose, but I just want 5 minutes from everyone interested to pitch their stock to us. These interview presentations will take place on October 14th, so you have about 2 weeks to do this. I don't think it's a tall task at all. Just 5 minutes, prepare some slides, make it look pretty, just to pitch the stock. And we have an interest form on the next slide. Scan this if you're interested. Depending on how many people sign up, we can potentially form a 3rd team. So you have really good odds. Like, your odds are in your favor, so I really encourage a lot of you guys to sign up. And this goes back to what we talked about in the beginning. Whoever's in those finance classes, the professors are looking for participation for extra credit. So you have a chance to win prize money, and your professors are willing to give you extra credit. It's a win-win. Plus, resume. Resume, resume, resume. Make your resume look pretty, right?
And this is also like a pretty prestigious competition. Like, it's
Yeah.
been going on for like 12 years, and usually the winners are like pretty well-known universities. Like Rice competes in this, WashU. There's like University of like Hong Kong. Like, there's a bunch of universities here. So like, this is like definitely like there's the real merit in winning and doing well in this competition. So strongly advise you guys to sign up.
And it's good hands-on experience. We're going to be working with a mentor, probably Dr. Dolman. He's giving a lecture here next week. He runs the Applied Portfolio Management Program. He has a business of his own. He's got tons of experience, and then he'll be working with us and several other investors here. So good hands-on experience, good chance to learn. So I strongly recommend signing up. And then some other interesting things that we got going. I'm sure a lot of you noticed the camera over there. We are recording all these presentations and posting it to the website. So those two lovely ladies just created a website for us. And it looks really pretty. I like it. So we can give you a little quick tour if you want to do that, Max. So it has some events that we have planned. We have confirmation that we're going to be going to SLU's Department of Public Safety to give a financial literacy seminar. Dates are still not confirmed. And then athletics, we'll be doing that. If you guys have questions, say you saw the news about something and you don't want to wait till Monday to get it answered, just fill out, write your question there, we can get it to you. We have an about section with all our emails. Reach out to us, some professors' emails. You can spam their emails. Don't spam ours. But yeah, so this is the website. All the lectures will be posted there. So feel free to look back at that. Or just shoot us a text if you want the slides or anything. We're here to help and make it fun. But yeah, I think that wraps up everything. We also have a LinkedIn. Connect with us on LinkedIn, follow our LinkedIn page, connect with all the EBOR. Network, 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 am I right? No one laughs at my joke. Okay, I think that's all we have. Any questions?
I wanted to ask, how do you think the Fed rate cut has affected the election? Do you think a juice economy is going to have air swing or?
Yeah, so that's always in the air. One thing that I saw, Jerome Powell was appointed by Trump. So a lot of people are saying this is good for Biden's presidency and they're doing it for that. I don't think it's related at all. I mean, they're doing their own thing. They're trying to do what's best for the economy. I don't think it's going to have an impact on the election or any presidency at all. And I hope the average American takes that into consideration when voting. But yeah, I don't really think it has a correlation. It's something people always bring up in the meetings, but I don't think so. Declan, you're smiling.
I'm just happy to be
Any other questions? Okay, well, if you don't have questions, feel free to reach out on the website with any questions or talk to us after class, shoot us a text, whatever is best. But if you need the attendance or the interest form or anything, let me know and we can go back to those. But looking forward to next week. Dr. Dolman's giving a lecture, so keep an eye out for that. I don't know if y'all have heard of the Applied Portfolio Management Program. Raise your hand if you heard of it.